The NAV was 10 times of the market capitalization. Hi guys, it's Eric from Hong Kong based in Germany. I've been investing since I was 17 years old for almost 20 years. I want to give you guys alternative perspective and local insights about investing in Chinese stocks as well as in personal finance. Today I want to introduce you guys to a stock which I had bought earlier with a target of 200% of profits. It has already risen 70% in the past 4 weeks and I am expecting it to go further. I always wanted to introduce this to you guys earlier, however, there are always so many topics coming up that's more urgent. But it's never too late. I still think that we can make a huge profit even by investing now. I've also made many videos about value investing and stocks that I'm analyzing. So if you want to know about them, click on the links here or here. The company I'm talking about is Seoul Santong Holdings Limited with a ticker number of 8200 on the Hong Kong Stock Exchange. The interesting thing about this company is that its NAV, the net asset value, as well as cash, are much higher than the market capitalization it has on the stock market. When I first looked at it, the price was around half it is now. At that time, the NAV was 10 times of the market capitalization, and the cash was 5 times the market cap. The NAV is 814 million Hong Kong dollars, including $402 million of cash. And the market capitalization, guess how much? 150 million Hong Kong dollars only. So even though the stock price has risen a lot in the past 4 weeks, the market cap is still only a fraction of the NAV and cash. In fact, the NAV is still 5.5 times of the market cap, and the cash is 2.7 times of the market cap, which is still a really good bargain. So what does Seoul Santong Holdings do? They are famous for well-being and skincare treatments as well as products in Hong Kong and mainland China. They also have lending businesses, real estate investment and financial investment. However, the biggest piece of revenue comes from its distribution of FMCG products in China. FMCG stands for fast-moving consumer goods. For example, shampoo, shower gel, toothpaste, beauty products, etc. And the bright point is that they're the top 3 distributor for P&G in Eastern China. So P&G is one of the biggest, if not the biggest, FMCG companies in the world. If you look at your kitchen or your toilet, probably half of the products are from P&G, just that they use different brands and you're not aware of that. The distribution business is also the reason why the stock price tanked, because they no longer have access to Tmall and also JD.com, 2 of the biggest e-commerce platforms in China. However, we see hints of recovery from the financial results. Q1 to Q3 2020 ending in December. Well, this is a British system, so the financial year ends in March. That's why Q3 ends in December. We see that there's a sharp reduction of losses from 28 million Hong Kong dollars to 5.4 million Hong Kong dollars of loss, which is a great improvement. Also, the revenue went up 24%, so we can see that there's hints of recovery from the financial results. But of course, the main thing is still about its NAV and also cash values. By the way, if you guys are interested in Chinese stock analysis, remember to click the subscribe button below, also the bell button next to it, so that every time when I have an update about the Chinese stocks, you will be informed. So back to the topic. I can see 3 upside scenarios. Scenario 1 is privatization by the main shareholders. At the moment, the price to book ratio, PB ratios, is only 0.18. Even if they pay the price doubled, for example, 0.36 PB ratio, they can still buy the company and left with a lot of assets. Especially the cash is 402 million Hong Kong dollars. And the market cap at the moment is only 150, right? So even if we pay double the price at 300 million Hong Kong dollars, they can still be left with $100 million of cash plus the assets. Let alone that the main shareholders already own some of the shares, so they don't even need to pay the full $300 million. For scenario 2, acquisition by an external investor or external companies. This chance is relatively high because the main shareholder only holds around 13.5% of the share. That means that it's relatively easy for external companies or investors to actually acquire the company with the similar profits in scenario 1. Scenario 3 is obviously the share price would just catch us up because it's just so undervalued in terms of cash and NAV. In any of the scenarios, the stock price would go up a lot. A word of caution as usual, this is literally a penny stock. It will fluctuate a lot, it will not be a surprise. Also, it never paid dividend, so this is not a long-term bet. And also you need to be very strict about cut loss. It has risen 70% in the past 4 weeks, so I expect that there will be some correction in the coming days. However, in the coming weeks or months, I expect it to still go up a lot. I'm planning to sell off half of my holdings in this company when it reaches my target price of $2.4, which is roughly 100% from where I had bought. So what do you guys think about it? Are you going to buy Southern Tone now or you wait a few weeks more? Leave me in comments below here. If you like the video, remember to like, subscribe and share. Even better if you click the bell button so that every time when I make new videos you will be informed and you're not going to miss out anything. This will be great motivation for me to make better videos in the future.